bringing you the latest in tax credit news, insight, and analysis. This is Tax Credit Tuesday with your host, Michael Novogradac.
Hello, I'm Michael Novogradac, and this is Tax Credit Tuesday. This is the August 11th, 2026 episode. As our audience on YouTube can see, my guest this week is Brent Parker. Brent is a partner in Novogradac's Long Beach, California office. And of note for today's podcast, he's the chair of the Novogradac 2026 Fall Affordable Housing Conference being held in Honolulu, Hawaii. That's coming up pretty quickly, September 16th and 17th. Now, in today's podcast, Brent and I are going to discuss how Hawaii is tackling their affordable housing crisis. Other states can learn a lot from Hawaii, as Hawaii is a particularly challenging state to build and operate affordable rental housing. During today's podcast, we're going to discuss some of the many reasons that's so, but of more importance, we're going to discuss some of the many financing tools adopted at the state level to help facilitate affordable rental housing. Now, when I think of the challenges faced by developers in Hawaii, I can't help but also think of the Frank Sinatra song, New York, New York, where an old Blue Eye sings, if you can make it there, you'll make it anywhere. In the affordable housing world, Hawaii deserves consideration for that time. Few places demand more persistence, creativity, and patience from developers. To paraphrase, if developers can make it there, they can likely make it anywhere. So if you're a developer in Hawaii, this podcast is for you. It's also a salute to you. If you're interested in developing and operating housing in the continental United States, this podcast is a chance to hear about some of the many state and local efforts used in Hawaii that could be adopted and then used in the states where you work. We have a lot to discuss today, so if you're ready, let's get started. Brent, welcome back to Tax Credit Tuesday.
Thank you.
This is your 9th appearance of the podcast and the first since last May. It's been a while, so please provide to our audience a brief overview of some of the many services you provide to clients at Novogradac.
Will do. So I'm a partner in the tax and audit practice in Novogradac based in our Long Beach office. So I think geographically as close to Hawaii without having a Hawaii office yet, but hopefully that'll change at some point. I'll volunteer to be the first partner in Hawaii, if that's okay, Mike. Anyway, I serve clients more broadly, primarily with real estate assets, focus largely in LIHTC space. That's where I started. I've been doing LIHTC for 22 years. And then more recently, other incentives like the Opportunities Incentive, some renewable energy and things like that. Like many of the partners in our firm, I attend to a full service approach where I assist clients with financial statement audit and other tax services, tax compliance services, as well as a wide range of consulting and advisory services, including but not limited to tax credit applications, particularly in Hawaii. So I have a couple of clients that are doing application work there as well. So a little bit of everything.
Thank you for that. Now, I do want to dive right in, and I want to start with a discussion of what does drive the cost of affordable housing in Hawaii and some of the reasons why it can be and is so much more expensive to build and operate in Hawaii than other parts of the United States. We can't go into all the factors, but if you could share with our audience a handful of the factors that are the key drivers of the higher cost.
Certainly. So I'll start with the low-hanging fruit, land costs. Land is scarce, obviously, due to Hawaii's sort of limited geography, extensive conservation areas, agricultural land protections, and military holdings. So this scarcity drives up the land prices, some of the highest levels in the nation. That in turn, obviously makes it difficult for affordable housing to acquire projects that pencil. We see increases over continental U.S. in the range of 2 to 10%, 2 to 10 times the cost in the continental U.S.
No, I like that. I'm sure some people are going, I wish it was only 2 to 10%. And also, given the Madami tax, tier-to-tier tax in New York City, it can't help but also point out the competition for tourism and second home demand further drive up average land cost.
Huge. Yeah. I guess if you have a second home, I don't know, there's too many better places. So, and then material costs, obviously it's a big, all the materials coming to Hawaii, most of them are being shipped. So it increases costs significantly, exposes projects to freight, logistic disruptions, et cetera. That can drive up costs in comparison to continental U.S. by 20 to 35% higher. And then finally, labor costs. Obviously, labor costs are elevated in Hawaii. You have specialized contractors that can be in short supply, developers required to pay prevailing wage rates in Hawaii, even where the Hawaii Davis-Bacon Act or HR Chapter 104 don't apply, you still have those costs that are basically at that level. So, chronic labor shortage and then heavy union density as well apply there. You see labor costs that outpace the continental U.S. by 25 to 50% higher.
Yeah, that's three of the big drivers. When you think of the land costs, the material costs, and labor costs, that pretty much is the bucket of most of your major costs involved for rental housing. So it's pretty easy to see how it's so much more expensive to develop there. Now let's turn to the sources side. We know the average cost is going to be much higher on the per unit basis for all those reasons, which then means we need that much more in the way of sources. So in terms of financing, let's start with the federal tools, foundational to a forward housing development, preservation, and renovation across the United States, or the federal 9% multi-state tax credit, along with private equity bond finance developments that bring 4% tax credits. Share with our audience the state play of both of these incentives in Hawaii.
Yeah, obviously we're talking about 9% credit or 70% present value credit and the 4% or 30% present value credit. I think when you're talking about the 9%, that was really reserved for new construction, requires deeper subsidy pencil, but it's limited. Even with the permanent 12% increase that we recently had enacted with One Big Beautiful Bill Act, it's still sort of limited, and it definitely provides some value, but it's very heavily competitive, especially in Hawaii. 4% credit financing gaps are structurally much larger, and you have to fill them with a variety of resources that we'll talk about that are available for use by developers. The reducing the 50% bond threshold to 25% has definitely eliminated issues in a lot of states, but Hawaii has historically actually not been oversubscribed on its bond cap, largely because Hawaii sort of fits within the small state minimum. And so it provided historically a generous per capita amount. However, recently, the demand for the private activity bonds in Hawaii has outpaced supply. For instance, I think 2026, we saw a Hulame multifamily revenue bonds pipeline was 554 million, which is well above the 397 million of annual allocation. So, Hawaii is trying to push the limit up. Recently had a bill that kind of stalled in the state, but they're trying to push that ceiling up because right now they're leaning on the carry forward from prior years, but that is definitely evaporating.
I will note when you're thinking of the 9% credit, the 4% private activity bond driven credit, you also have to be thinking about whether or not the development's in a QCT or DDA. If you're in a QCT or DDA, you get the 30% boost. Large portions of Hawaii, but not all of Hawaii, are in either a QCT or a DDA. It's called a census tract or difficult to develop area or development area. And when you're thinking at a policy level, the one thing about this 30% bonus is a particular project is eligible for more credits. But if you're getting the 9% allocated credits, then the more credits you get, the less they go somewhere else. So while your project might become financially feasible, you're taking away credits from other projects. That's not true when you get the develop bonus on the 4%. You basically get a higher credit rate, now since 5.2%. And you're not taking away credits from other developments. So developers, obviously, when they're looking at sites, need to be identifying sites, if possible, that are in QCTs and DDA, particularly if it's a bond deal. And I will note, as you know, Brent, or many of our listeners don't, we now have QCT and DDA estimator tool, where you can basically estimate whether or not a given site is likely to fall out of being a DDA or QCT, or likely to become a QCT or DDA, or likely to stay as a QCT or DDA. And that's something that right now we're estimating it roughly 6 months to a year before HUD will come out with their numbers. And we're working on the tool to go build it in a year and a half ahead of time. But even if it's 6 months quicker, if you're out there looking at sites and the rest, and you don't think you're going to be applying for resources till next year, you want to know what the probabilities are there as soon as possible so you can focus your efforts. And I'll include a link in our show notes to that tool. It's super valuable and part of a number of tools that we have here at Novogradac, like the rent income limit estimator and the like. But I just want to make sure I pointed out that QCT and DDA as a way of getting 30% more federal tax credits for a given transaction. But let's come back to what Hawaii is doing. Hawaii is really a national leader in developing resources to help leverage the federal resources. And if you could run through the various, just give a quick 1, 2, 3, 4 of the various tools that Hawaii has created. And then I'd like to go through each tool sort of one by one.
Sure, we'll do. Real quick, Bill, before we go there, if it's okay, yes. On the DDA QCT topic, Thomas Stagg, who's our partner in Washington State, put a really good article in the end, I think October 2025, about how to preserve your DDA or QCT. I just wanted to put a plug out for that too, because that's an interesting topic and a good read.
And I would just say too that was applicable then. And whenever HUD comes out with that new guideline, that new designations, you didn't have to look at those to what extent they change. So people should definitely read that. That's likely what will be in effect at the end of this year, but not absolute. Appreciate you pointing that out, and I'll include a link to that in our show notes.
Thanks, sir. So state programs, Hawaii is very robust, does a great job. I think is one of the leaders in all the resources that they have available and the efforts that they make to help developers and help folks get projects done. The one big program that gets a lot of discussion, obviously, is the state LIHTC. The state LIHTC in Hawaii is equal to 50% of the federal credit or federal credit, making Hawaii one of the most leading states in the country for that state match credit. Since 2017, the credit is allocated over the first 5 years, so it's accelerated at that. The interesting note, recently Hawaii enacted HB 1920 that extended the LIHTC sunset from 12/31/2027, the state LIHTC sunset, to 12/31/2032. And interestingly, it allows a partner or a member in the LLC that owns a project that itself is a partnership or LLC to transfer or sell a portion or all of their credits to an outside taxpayer or external taxpayer who doesn't hold any direct or indirect interest in the building. So the mechanics of that are being worked out right now. And I think that's going to be something where, it's probably going to be talked about at our conference along with all these other incentives. But the state credit is a big one, obviously. I think we have a whole panel that basically talks about that.
I want to say kudos to Hawaii for extending it. Kudos for creating transferability. So there's more options that should drive up the average equity price for the credits and lead to more resources for affordable housing.
Definitely. It's outside the box thinking is great. We have the Rental Housing Revolving Fund, or RHRF. This is really kind of the workforce for Hawaii soft financing. It provides low interest loans, project owners intended to offset these high costs that we've been talking about. It's used for development, construction, acquisition, preservation, and rehab of affordable rental units. It's formerly the Rental Housing Trust Fund, and it's funded from 50% of real estate conveyance tax proceeds up to a $38 million annual cap. And it's generally a residual receipts loan product. So you're going to pay to the extent there's cash flow. Within RHRF, there's 2 tiers. Tier 1 finances projects at or below 80% AMI. And tier 2 is sort of more middle income. It targets households above 60% up to 100 to 140% AMI. So for workforce renters. Tier 2 projects require a little bit less subsidy, carry shorter periods, revolve faster, but of the total sort of allocation amount, maybe about half of it's carved out for tier 2 mixed income deals. So that's the first 2-part state specific funding program. The second one to talk about is another revolving fund. It's the Dwelling Unit Revolving Fund, or DURF, and it's land infrastructure interim financing. So DURF is established in 1970. It's the older of the funds. It works a little bit differently than RHRF. It's aimed more at land acquisition, infrastructure, interim construction financing. But again, it's a revolving fund. So as proceeds come back, they're then redeployed. So there's a continual process. And it's definitely a very big impact to developers in Hawaii. In addition, you have Home Housing Trust Fund, HP, county loans, things like that, that are very impactful to my clients in Hawaii. And I think most developers are familiar with those products, but yeah. So I wanted to spend another minute on some of the non-Hawaii specific financing, if that's okay, Mike.
Right.
So in Hawaii, unfortunately, we have some natural disasters and things that are not specific just to Hawaii, but definitely Hawaii has had a few that have impacted my clients and are devastating when they do. The Maui 2023 wildfires, the more recent flooding. And so there are programs that specifically are geared toward those projects. The CDBG DR, so Community Development Block Grant Disaster Recovery Grant Program, is one that's available. Also USDA has emergency assistance that you can tap into. So there's a lot of that funding that some of it comes a little more quickly than others, but it definitely is out there, is available, and is flowing. Also, I was just going to touch quickly on the Capital Magnet Fund. So I work a lot in Capital Magnet Fund, so maybe I'm biased and don't want to sort of sing its praises, but it's a fantastic grant program that's administered by the CDFI Fund, which is a component of Treasury. It provides grants to nonprofit developers, managers, and CFIs, which are community development financial institutions. For debt funding, particularly on affordable housing, could be pre-development to perm, whatever. And it's a 5-year compliance period after which the proceeds are released from restriction. And grant size ranges from $500,000 or so to $10 million up. Right now, I think we're waiting on the latest round to be released. So we're hopeful that that happens at some point soon here, but it's a very impactful program as well.
I would encourage our audience to reach out to you if they can apply for funding. Maybe you could describe the types of entities that can apply for funding.
Yeah. So the funding is specifically available to nonprofit developers or managers in the affordable housing space and community development financial institutions, which can be for-profit entities. So both nonprofit and for-profit. Also have a lot of clients that if they're a AGP or an administrative general partner a deal and they work with the managing general partner, maybe they'll have the managing general partner apply as a nonprofit, things like that as well. But a for-profit entity can set up a CDFI funding entity and then apply as well in that capacity.
Great. Thank you for that, Brent. And one other item I wanted to mention, we talked about this as not so much a financing tool as much as a lowering cost tool. If you could talk about 201H exemptions.
Yeah, thank you, Mike. In the beginning of June 1st, actually, I was at a conference in Honolulu where we were talking about opportunity zones, but a lot of it was affordable housing oriented. And one of the things that was touched on, which made an impact on me and I thought was interesting, is the 201H exemption. So it's not like a financing component per se, but it's a powerful cost reducer that effectively shrinks gap. It lets HHFBC exempt qualifying projects from, quote, all statutes, ordinances, charter provisions, and rules on planning, zoning, and construction standards, as long as they have at least 50% of units plus one unit reserved for at or below 140% affordability of 45 to 61 years. So if you're already locked into the long term, it's definitely helpful. It adds help for density, height bonuses, reducing parking, waiving certain fees and things like that. So it definitely can bring costs down significantly. And that was an interesting thing that I learned earlier this year that a lot of people are trying to tap into.
Excellent. Thank you for all of that. Now, I mentioned our conference in the introduction. It's coming up in about a month. And once again, to our audience, it's our 2026 Fall Affordable Housing Conference in Honolulu on September 16th and 17th. Brent, we're going to have a full day and a half as well as some pre-panel days. So we'll have essentially 2.5 days for those who want to enjoy all of the conference in the early sessions. Can you describe, I know you can, so I'll ask you to, please describe or highlight some of the panels we're going to talk about or topics we're going to talk about on those panels?
Right. So obviously I'm going to lead with my favorite. And I think if I didn't say this, I might not have a job, but I thought you would have a job. Okay. But it is my favorite, the Washington Wire. I think it's everybody's favorite, but lead the panel. It's kind of a fireside chat with you and Scott Glenn from the governor's office, where you'll be talking about the latest on Capitol Hill and the State House building in Honolulu and what's going on in the inside workings there. So I think that's a great one. Followed by Developer Spotlight with our partner, Craig Staswick, also from Long Beach. And if you're interested, he might teach some surfing lessons out there too, but I don't know. But anyway, that's going to be a good one where developers talk to him. Then we have an equity panel that I'm leading with some fantastic investors and syndicators on the state of equity in Hawaii. We've got a great debt panel. And then we have sort of housing strategies in Hawaii with Masio, where they're going to talk federal, state, and loan approaches and local approaches to what's going on in Hawaii. And then I got to be honest, other than the Washington Wire, I think my two favorite panels are really the second day. And so we have two. The first that's led by Kevin Wilson, where he's going to sit down with some folks like Catherine Lyons and Lee Brown, both very influential players in the opportunity zone landscape and just community development in general. And they're going to talk about alternative financing options in Hawaii. I think they're going to talk about things like CDBG, permanent supportive housing, clean energy incentives, et cetera. And finally, the last, but definitely not least, Nicolo Pinoli is one of our most exciting partners, in my opinion. But he's going to sit down with industry leaders such as Kathleen Wilhelm from Sugar Creek and discuss the status of state tax credits and other gap fills in Hawaii. So I think that's a very hot topic.
Great. Thank you for that. I'll just reach out to our audience and see if there are additional topics and such you want to make sure we cover during that conference. Please let us know.
Please let me know. Yeah.
I'll look forward to seeing you in Hawaii, Brent, in the not too distant future.
Getting my shirts ready. It's my favorite place for business attire in the world.
Yes, me as well. Me as well. Do not bring a tie. Bring a Hawaiian shirt. Brain spooner is a good choice.
There you go.
So you've shared a lot of resources for funding affordable housing. And as you noted, these resources are helpful in Hawaii, but also useful to be adopted in other places that can be used there as well. And as I mentioned to our audience, if you have ideas as to other state and local resources that you use in Hawaii or elsewhere that we should be identifying and discussing in future podcasts, please let us know. You can reach us at contact@novoco.com. And then we can potentially do a deeper dive in some of these other resources. So Brent, before we turn to the off mic section, is there anything else you want to share with our audience?
Well, I think I'm looking forward to seeing everybody in Honolulu or in Waikīkī. Really, it's a fantastic resort. It's the Hyatt right there, right across the street from the beach. And just looking forward to seeing everybody there on September 15th through the 17th. 15th is the pre-conference workshops, which are both going to be fantastic as well. And then we have the Housing Tax Credit and Bonds Conference in Nashville on October 1st through 2nd. So that's going to be super exciting. And call me if you have any questions on anything and everything.
Great. Thank you, Brent. To my audience, our audience, for more information on the topics we discuss, I do encourage you to reach out to Brent via the show notes for this episode. His contact information will be there. If you have other thoughts on what we discussed today, please share them with me and our team by emailing contact@novoco.com. And if you receive value from today's episode, please subscribe to Tax Credit Tuesday, your favorite podcast platform. Please share the episode with colleagues. Please visit today's show notes for additional resources. And if you have ideas for future episodes, please send us an email as well. And with that, I'd like to turn to our off mic section. We'd like to use this space to give a shout out to others working in the tax credit and tax incentive communities. An opportunity to highlight a professional worthy of recognition. Brent, who would you like to shout out?
Well, again, I'm going to be biased on this mic. I'm going to go with John Lee, who actually worked alongside me in the Long Beach office of Novogradac in the early years of our office. And I just kind of keep seeing his name everywhere. He's going to be presenting with me on the equity panel in Hawaii. He's currently Managing Director for Investor Relations and Funds Management at Hunt Capital Partners. And just a very impactful, I think, individual, as impactful as any on that side for Hawaiian affordable housing space. Again, he's going to be at the conference, so please take the opportunity to come hear from him and other incredible industry insiders and speak in Waikīkī in about a month.
Great. Thank you for that. I echo your shout out. I know Hunt is a notable investor in Hawaii, and I look forward to seeing many of their team at our conference as well. Thank you for being on the podcast today, Brent. And to our audience, I'm Michael Novogradac. Thanks for listening.
This weekly podcast has been brought to you by Novogradac. Archived podcasts are available online at www.novoco.com/podcast or by subscribing to the Tax Credit Tuesday podcast in iTunes, Spotify, YouTube, and Radio Public. You can find related links referenced in this podcast on our website at www.novoco.com/podcast. Novogradac is a national certified public accounting and consulting firm with offices nationwide. Learn more about our professional services at www.novoco.com.